The fateful day is here. We are less than 24 hours away from the Federal Reserve's final policy announcement of the year, and it promises to be an interesting one. That's what we're going to figure out here on Macro Money. This is Ilya Spivak, head of global macro at tastylive. We are going to unpack what the Fed is expected to do and not to do and at this announcement, and then also get into which part of this is actually market moving, because it probably isn't the actual rate change that's on the menu. So what we'll do here is we will unpack what is expected. We will take a look at what it means, and then take a look at some of the benchmark assets, some of the critical assets that are likely to be impacted, what that means in practical terms, what the key levels are, what the trading opportunities might look like. So let's go down the list here, and first benchmark the outcome of the meeting itself, the policy change on the menu. The markets are overwhelmingly convinced that this meeting is going to give us another 25 basis point rate cut. That is, for all purposes here, a given when the probabilities are this high. Now, of course, nobody can tell the future with perfect clarity, but when the likelihood is tilted to this dramatic extent, the Fed is not in the business of rug pulling markets and creating untoward volatility. So if the market has talked themselves into a 95.4% probability implied in Fed funds futures that there's a 25 basis point cut here, it is overwhelmingly likely that that cut is coming. It also is the case that then there is no market moving potential, or almost no market moving potential, aside from some initial wiggling here and there, to the rate change itself, because it is already in the price. Fed funds futures are telling us the markets are already priced for the cut. Indeed, this is the essence of how volatility works. Volatility in response to economic outcomes happens when those outcomes are different from what the markets already have benchmarked in asset valuations, and therefore there is a reason for those valuations to change. There's reason for people to buy and sell things because they find themselves wrong-footed. That is not the likely outcome if the Fed delivers precisely what the markets are anticipating. And so from the rate change itself, we have virtually no vector by which that volatility occurs. But this is one of those big quarterly Fed announcements where there's much more on the menu than just the rate change. And there we turn to the update of the Fed's summary of economic projections. This is something that happens once a quarter, and the last time we got it with explosive effect was in September. What this did last time was instigate 2 months of a dramatic shift across the markets, and what this might do again is something similar. Now, when we say the markets, for the purposes of this conversation, we have to jettison the shorthand that quote unquote the markets means stocks. Because the relationship between Fed policy odds and the stock market, it's been, let us say, varied and diverse over the course of this year, depending on context. But the relationship between what the Fed has done and interest rates, and thereby bonds and currencies, that has been very straightforward. When the Fed last updated this, that was, of course, when they kicked off their rate cut cycle in September. What we saw was the Fed say, here we are at rates that are average 5.75% 5.3 and change, 5.33 to be specific. That's, of course, the middle point between the last and the peak level for Fed funds after the 2022-2023 rate hike cycle. That was the 5.5 to 5.25 range, and of course the midpoint there, 5.33. So when the Fed kicked off this rate cut cycle in September, what did they say? They said for 2024, the rate will be 4.4. If the rate is 5.3 and it will be 4.4, well, shock of shocks, that's 100 basis points in cuts. That's 4 rate cuts. The Fed delivered 50 basis points up front in September with 2 meetings left in the year. It isn't a stretch then to say November and December would be quarter-point cuts apiece. And of course, the Fed endorsed this idea. So what we then see with this cut that we're about to get after a third cut in November, this would be the 4th. This would complete this forecast. The Fed will have delivered exactly as advertised. The larger question, and indeed you can see this in policymakers' own conviction levels, is what happens next year. Now, the Fed, again in this September update, said we're going to go from 4.4 to 3.4 in 2025. That's another 1% or 100 basis points in cuts. If we look at the almost now mythical dot plot here, this is the Fed's vision of which policymakers or how many policymakers voted for what outcome, we can see there's lots of conviction in what there is to do in 2024 for the Fed. Much less so in what there is to do for next year. Lots more dispersed, as we can see. And what the markets have done since this meeting is shift to a much more hawkish setting for what comes next. Note, here is the curve that was there in September. Of course, we've had 1 rate cut since then. That was November's cut. Here is the curve where it was in November. You can barely see it in the little dots because it is almost identical to the current curve as of the start of this week. What you see is rates now by the end of next year are expected to be quite a bit higher. Almost a 100 basis point difference by November relative to what was there in September. The markets have made a significant hawkish shift in what they expect is coming next. They, of course, are still baking out rate cuts. We can see if we're currently at 463, discount that by 25 basis points for this cut that's incoming, and you end up with a path down by November to 3.9, let's call it 4%, give or take, and you're still looking at least 2 rate cuts. As a matter of fact, if we look at the way that this has evolved, we can see there's the start of the Fed rate cut cycle. This is right before that 50 basis point cut occurs right here. The market has a cumulative 230 odd basis points baked in for this year and next, of which 100 basis points happens this year. 75 of that has already occurred. 1 more is due. That leaves 130 basis points for next year. Over the course of the subsequent months, since mid-September through about mid-November, we went to 50 basis points essentially, even a little bit less, giving us 2 cuts as opposed to 5, which is what 130 basis points would imply. Now, what is it that got the markets looking at the Fed and going, there's no way you're going to do 100 basis points in cuts, your forecast is wrong? Well, take a look at what U.S. economic data was already doing going into September's announcement. Already by late August, U.S. economic data started to improve relative to forecasts. This is data from Citigroup, and what it shows in this very helpful index isn't so much whether the economy is getting better or worse, whether the data is getting better or worse. This is actually much more powerful, at least from a trading perspective. It tells you whether the data is getting better or getting worse relative to expectations. Because as we said at the top of our conversation here, it is deviation from forecasts that generates volatility. It's not good outcomes or bad outcomes per se if those outcomes are already priced in. So in late August onward, by the time the Fed actually makes its move, this is already meaningfully improving. And what that tells the markets is that the Fed is dumping stimulus. It is saying it is going to do, in their estimation, 200 basis points in rate cuts, with 50 up front and 150 spread over November, December of this year and all of next. And that they're going to do this when the economy is not decelerating, but seemingly performing better than anticipated, and increasingly so, at least until mid-November, when the tune changes. And so what the markets reason is that, okay, well, the Fed's not going to do this much because as they start easing into a hot economy, they're going to bring inflation back up. And that, of course, will stop them in their tracks because they still want to get to 2% inflation. You see that in very clear terms here. Already by the time you start September, the market is starting to sniff out that the Fed might overshoot on the dovish signaling, because the bond market is starting to show you that inflation expectations that are priced into 5 and 10-year paper is starting to rise. This is derived by taking the difference between nominal 5 and 10-year U.S. Treasury bond yields and their TIPS, or their inflation-adjusted equivalence. That inflation adjustment, of course, is what ends up being these curves, these break-even rates. So what the bond market starts telling us already in early September, even before the Fed acts, is that inflation expectations are on the rise. When the Fed finally does act, that marks a bottom in bond yields. They go up across the curve, both the 2 and the 10 years. And the dollar goes up because, of course, higher yields make the dollar that much more attractive relative to other currencies. If you earn better yield owning the dollar relative to, let's say, the euro or the yen, then, and of course, especially the yen, which is a perennially low yielder, then you end up with a stronger dollar as demand goes to where the yield is. Since then, we can see from about mid-November, this has kind of started to idle. There was a bit of a pullback in the narrative. And as we've kicked off December, we've basically reset to where we were, where this move found its exhaustion point. So we had about a 2-month adjustment, mid-September to mid-November, bit of a digestive pause, and now we're right back to where we started on the dollar, on the yield curve, on the 2s and 10s, and indeed on inflation expectations. So the market has spent all of this time, 3 months really, readjusting and then anchoring to a Fed that's going to have to walk some of its dovishness back with this week's update of the summary of economic projections and its forecasting. So that's where the market already is. They know, or they think they know, that this number right here is too low. And that what this number has to do is go down. And if you believe and take at face value what the markets have done here, the move from 130 to 50 is not quite a decline that's 3 times, but it's over double. So the outcome has been cut in half. we are expecting less than half of the rate cuts for next year, looking at what the markets think, than what the Fed actually projected, and indeed what the markets themselves had. So if the Fed were to pace markets here, and we sort of account for the idea that the Fed is not as sharp in its adjustments, then we might say, okay, well, the Fed is going to have to go from 4 cuts down to 2. Probably not going to go down to 1. That's probably more aggressive than they're willing to do. So let's say that this number goes from 3.4 to something like 3.9. And then you'd have 2 cuts rather than 4 in the outlook. And that would be baseline. That would be the Fed basically saying, okay, the markets have told us where to go, and that's where we're going to move. But the message that we've been receiving from the Fed has been one of, let us say, committed gradualism. This is from the minutes of the Fed's latest meeting in November. And what we find is that the Fed is both committed not to pre-commit, that is to say, they don't want to put themselves on dovish autopilot, so they've sort of tacitly approved the market's rethinking on where rates are going and said, yeah, okay, maybe we got a little overly dovish there. But at the same time, they're saying we're allergic to overreaction. We don't want to overshoot. We don't want to overextrapolate from near-term developments. Take a look at what this says. And the FOMC minutes are always instructive in that they give you a sense for the degree of consensus around the various ideas. So we can see here, many participants noted the volatility of recent economic data and highlighted the importance of focusing on underlying economic trends. That is, the Fed does not want to overreact. Almost all participants judged that though month-to-month movements would remain volatile, incoming data generally remained consistent with inflation returning sustainably to 2%. So the markets have worked themselves up around jumpy PPI data, let's say last week, to barely 50 basis points, but the Fed is saying, yeah, okay, if we thought it was 100 basis points last time, it's probably less. It's probably not half. Or at least we're not going to make that determination in one jump of a revision. So here we have an argument for gradualism. And of course, here we have the already well-established expectation of a large majority, quote unquote, of Fed officials that favored this 25 basis point cut in December. So already we know the Fed has taken this into account in its thinking, that this cut is a given, and that what the Fed then does in planning what it does next assumes that it occurs. What does that mean? Well, here's the move in bonds that has occurred in the wake of the Fed September announcement. Here's mid-September. This is what the Fed's forecast did. This is what 100 basis points in the Fed forecast for 20 to 25 meant for markets. They said, yeah, okay, no. And so yields went up, bonds went down. We see that there's been some digestion of this in the second half of November and into the first half of December, and we now find ourselves right where we started. Now, if the Fed comes out and says it'll be 3 cuts in the forecast and not 2, well, then the market is perhaps off sides. Perhaps it's made too much of a hawkish adjustment. And then what happens is the bonds bounce. Now, do the markets then overshoot? Fed will, of course, depend as things develop. But the risk seems to be that the markets have overstretched, that they've gone too far, that they're now off sides, and that the Fed's sobering effect is a lift on bonds. The other side of that is the same conclusion for the dollar. Again, here's mid-September. The dollar rapidly appreciates. This is against the euro as a kind of liquid standby for the overall direction of the dollar. This is its most liquid counterpart. And what we find is that we're struggling to keep going, that we're carving out something that's starting to look like perhaps a bottom. And if we extrapolate a breakout here, if 106.30 or so is the neckline on this consolidation, a close above it would imply back up to 108 or so, maybe a little bit over. So this could be the ingredients for a bounce in the euro. It could likewise be the fodder needed for another rise in gold. Now, we see here that last week gold powered higher as we got news that China has resumed buying for their reserve account in November after pausing from April after a 18-month grabbing everything that's not nailed down kind of accumulation. But of course, then it seemed like the market started to pay attention to the Fed and to the rebound in yields. That would be this right here. And gold reset, came back down to that digestion area. Now, if bonds go up, yields fall, and the dollar weakens, the path of least resistance would be for this to extend back out. And if we can get north of the 2,700 figure or so here, well, then maybe there's a run at the highs at the 2,800 mark that follows. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am also on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Wednesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and commenting sporadically on the platform formerly known as Twitter, as well as now on Blue Sky as well, at Ilya Spivak. If you're watching this on YouTube, like and subscribe, and check out our new live streaming of evening shows on YouTube. That's at the Tasty Live Trending channel. Make sure to see that as well. You can comment live as shows go. Thanks very much for joining. Macro Money's back tomorrow.